Based on available indicators, the Bahamian economy maintained a healthy growth rate during the first half of 2026, closely keeping pace with the estimated gains recorded in the first half of 2025. Tourism expansion strengthened in comparison to last year, with accelerated inflows from stopover activity occurring alongside continued robust expansion in cruise visitors. Foreign investment indicators also steadied, stimulating healthy construction output, and alongside tourism contributed to further estimated growth in employment. Meanwhile, moderately paced private sector credit expansion helped stimulate domestic spending, with lending risks further reduced in the banking sector. Likewise, the economy continued to support improvement in public finances. However, given external geopolitical pressures, average consumer price inflation increased in the most recent estimate, driven by escalated fuel costs and rising prices for other imported goods and services. As to the outlook, global economic uncertainties from wars in Eastern Europe and the Middle East, alongside persistent tariff policy tensions, continue to underline the increased headwinds facing the economy. For 2026, forecasted growth is on pace to come in just moderately below the estimated 3.8% recorded in 2025. For tourism, this includes an expansionary year-to-date contribution from stopover earnings, benefiting from slightly recovered visitor volumes and further appreciated average pricing, but with constrained hotel room inventory still limiting overall performance. Although rebounded against 2025 comparatively, the monthly seasonal volumes for air arrivals have not shifted significantly since recovering to the peak baseline head count recorded just before the COVID-19 pandemic. So if you were to look at the trends on a graph, you would see that the recovery took place up through about 2022, and then we've been hovering fairly level since then, looking at the month-over-month seasonal comparisons. Otherwise, tourism performance also reflects a fairly robust uptake on vacation rentals in place of constrained resort accommodations. In addition, vigorous demand growth from the Canadian market for the second consecutive year has been supplemented in 2026 by a more stabilized and incrementally improved outcome for the US market. In the meantime, cruise visitor inflows have remained strong. With regard to foreign investments, inflows remain concentrated in residential activity, resort developments, and further development of private cruise destinations. These are generating both construction jobs and anticipated permanent positions once the development transition into operation. The foreign exchange markets underscore also significantly accelerated private sector inflows during the first half of 2026 compared to last year. In particular, commercial banks' total purchases of foreign currency from the private sector rose at a robust pace of 17.8% to $4.6 billion in the first half of this year, far exceeding the 1.3% pace of expansion in 2025. Also, in line with increased demand for payments, mainly for imports of goods and services, total sales of foreign exchange to the private sector through the banking sector increased by 13.7% to $4.1 billion in the first half of 2026. And the resulting seasonal net inflow resulting from these transactions was correspondingly two-thirds stronger than in 2025. And this contributed to a significantly expanded amount of net sales of foreign currency by the banking sector to the central bank. With the central bank's net sales of foreign exchange to the public sector only marginally offsetting these net receipts from commercial banks, the external reserves growth through the first half of 2026 was boosted to $480 million from an otherwise healthy but more moderate $355 million recorded in the same period of 2025. Near the end of July, the external balances were estimated near $3.2 billion compared to a value of about $2.97 billion at the end of July 2025. Given current balances, external reserves are expected to end the year at stable to possibly improved levels in comparison to December 2025. And this maintains favorable support for the Bahamian dollar fixed exchange rates, and it leaves continued room for the central bank to accommodate strengthened private sector credit growth over the medium term. Turning to lending, the pace of bank lending over the first half of 2026 was firmed in comparison to 2025, and this reflected stronger net flows to the private sector and a recovery in net lending to the public sector. After adjusting for transactions which reclassified some commercial credit into public enterprise liabilities, the data revealed that the private sector continued to experience moderately firmer lending growth compared to the same period last year, and that included accelerated consumer credit increases and a nearly doubled net advance for commercial credit. Mortgages were mildly increased, but mainly denominated in changes in foreign currency balances. Compared to the same point a year earlier, lending risks also continued to subside in the banking sector, a benefit of both the healthy economic environment and effective ongoing management of delinquencies by banks. In particular, the share of loans more than 3 months behind in payments, the non-performing loans ratio, moderated by approximately a full percentage point since June 2025 to an estimated 4.4% in June of this year. Now turning to inflation briefly, as noted, there was recent firming owing to higher prices for imported fuels, and this impacted transportation costs as well as a range of other goods and services in terms of the pass-through. And so we have seen that the estimated inflation rates have firmed year over year. For the time being, though, some domestic energy costs have remained sheltered given the electricity fuel hedge. It's important to note, however, that some adjustments in the fuel hedge are expected to occur before oil prices fall back to their pre-war levels, and this could pass higher costs through to electricity generation after 2026. In the outlook, the pace of growth, as mentioned earlier, is expected to stay elevated above the estimated medium-term potential, but moderately tempered below 2025. For tourism, stopover momentum could strengthen moderately, particularly on the basis of what we are seeing in the outlook in terms of appreciated pricing and some seasonally improved forecasts of average occupancy over the traditionally slower months in the second half of 2026. The foreign investment climate is also expected to remain relatively vibrant. The outlook also remains consequently improved for employment. In addition, the pace of domestic credit growth is expected to be maintained at a stable to strengthened level, in line with the central bank's policy to encourage firmer lending trends, and within these trends, still a continued very healthy outlook for the external reserves. Ample capacity continues to exist in this credit and liquidity environment to accommodate increased government reliance on local currency financing relative to foreign currency sources in its overall debt management operations. And that's another way of saying that even in this environment, there's also favorable space for even the government to borrow more in local currency and without creating any pressures. Nevertheless, there are downside risks and headwinds facing the economy, which remain elevated given the spillovers from wars in Ukraine and the Middle East, and from persistent tariff policy uncertainties. Tourism in particular faces some demand restraint from fuel cost pass-through into transportation and electricity costs, as well as the weighing down, particularly of U.S. consumer confidence, given the varied channels through which inflation has become accelerated in the US. In addition, higher inflation in the near term continues to slow the pace at which international interest rates are likely to return to lower levels. And this is being forecasted to maintain public sector foreign currency borrowing costs more elevated for longer than would have otherwise been expected. And on a protracted basis, it makes it more challenging for foreign investment activities in the aggregate to secure funding. So it means that in terms of the observed level of economic activities, one can anticipate that those results would be even more robust and vibrant in the absence of these sort of headwinds. In this environment, the central bank will remain balanced in its approach to policies which seek to support to strengthen credit trends while staying vigilant to ensure that the outlook for external reserves maintain adequate support for the Bahamian dollar fixed exchange rate and in continuing to ensure that domestic financial stability risks are kept in check. So we will stop here and take any questions you have.
So, Mr. Roll, as you mentioned a number of headwinds, and you mentioned the fact that we have, in terms of the steady growth with our economy, but more importantly, you also hit on the fact that we've seen the impact of fuel on the high cost of living. But with the number of rolling blackouts that we've been facing over the summer, do you see that having any major impact on the economy overall?
I would not want to draw too many new conclusions from that. I think what's more important is that we are in a period where we're making a lot of interventions to improve the energy sector, and the improvements are supposed to have us benefit from structurally reduced costs. That's what's potentially important, particularly in terms of how it could improve the potential growth path for the country.
So based on your numbers and the research, the central bank cannot definitively say that during the first quarter that the energy sector has had a major impact on the economy.
We have not done any quantitative work, but you want to be very careful in trying to connect any dots from a few power supply disruption to the economic performance. I think it's better to say that if you look at the overall cost structure in the Bahamas, the cost of energy is a factor in terms of those tie-break decisions that are being made around investments, and that is not a 2026 issue. That is an historical issue, which the investments in the sector will potentially address by reducing some of the baseline costs for electricity generation. So that's what's positive. And what's also positive about it is that a lot of the investments that have been formulated over the last year plus are investments that are making use of liquidity in the domestic financial sector. So that's a very good thing. And there's a lot more capacity for private sector mobilization of liquidity through such types of intervention, which is separate and aside from just the direct bank, the private sector lending.
Last night's outage, do you know about any effects to the banking system today? I understand several ATMs across the island have been out or were out.
I'm not aware, but I mean, I think again, I'm not going to draw any conclusion from a single event. Financial institutions typically have very good business continuity plans with reserve power supply. So you would need to be very careful in taking note of where those ATM machines are located and what direct continuous control that banks have over those. So a lot of the ATMs on this island, in fact, the majority of them are probably located outside of the banking premises. So you want to bear that in mind.
In terms of commercial lending, can you, I don't know if you could explain who's coming to commercial banks for lending? Is it typically larger companies? Is it people with startups? Can you explain what you're seeing in the ecosystem in terms of
We don't
commercial?
have a we don't have a very granular view of who those borrowers are, but in many cases they tend to be larger businesses. And in the recent year or so, a significant chunk of lending has also mobilized to finance some of these energy projects.
And we know recently the US announced the 12.5% tariffs on export. Has the central bank had an opportunity to talk to stakeholders about any concerns moving forward on what this would look like for exports?
Well, the understanding what's happening in terms of the tariff space. It continues to be an area where I think more research is needed. Um, if you follow some of the public dialogue, there's been an emphasis on what it would mean, say, for example, for the seafood export. So it's one of those singular items that we can identify. Um, the Bahamas also has a lot of transshipment activity. If you read the U.S. Proclamation very clearly, you would see that there's some delineation to separate what's happening in the transshipment space from the direct export. So we need to also drill down to identify um, the specific categories of commodities and goods that are being exported from the Bahamas. We know that the fisheries products are one of those, and it's probably one of the most concentrated export categories that people can point to.
How does the central bank look at the disparity between, say, say Fitch, when they look at what government is going to make in terms of surpluses and what the government says it thinks it's going to do? How does the central bank look at those kinds of things?
I think that you want to be careful in trying to, sensationalize some of these. Um, Whenever any report is produced showing public finances, any one of us can go through those reports and look at the itemization of what's being forecasted, and we can vary those assumptions and draw different conclusions. And so you need to take those analyses in the same light. The headline analysis and conclusion from all of these reports, which is important, not the point estimates, is that public finances are consolidating. And we need to take from it that public finances consolidating means that over the near to medium term, the net amount that the government needs to borrow will be reducing. And at some point, the government will get to a point where, on a net basis, it's going to be repaying liabilities. I think that's the big picture that needs to be kept in view.
You mentioned that there's more room for the government to raise money locally. That seems to always be a bone of contention when it comes to these international agencies that look at the Bahamas and the way companies, I guess, use government paper. I guess they think it's spread too thin or something. How do you look at that?
Well, a part of what is happening when we talk about the government being able to make more use of the local market is the super majority of what's happening on a yearly basis in government borrowing is just refinancing. And so in that refinancing mix, the government has the opportunity to refinance some of its debt out of foreign currency. And so the domestic market being able to absorb more government borrowing is also facilitating the government's shift in the mix of its debt, even in the context where the total stock of debt might not be growing overall. But what is important also to notice in this, in terms of when you assess, okay, if external observers are looking at whether the government is able to access the markets, what you also need to read from these trends is that the domestic investor market also has warmed up more to taking government instruments. And that's partly the reason why, notwithstanding the amount of liquidity, the government is able to access these markets to a greater extent. And so that, I think that is what is important here, that it also reflects local investor sentiments. Notwithstanding whether you have varied views on the point estimates, local investor sentiment that the direction in which you're headed is one of improvement. I don't know if that answered the question.
Kind of, but I know at some point smaller businesses and maybe individuals felt locked out of buying government.
No, there is no, I would say, loss of access to government securities in terms of the investor base. As a matter of fact, on a strategic basis, part of the heavy lifting for the central bank and the Ministry of Finance is to continue to grow the investor base and make it broader. So pulling in a lot more of those smaller investors and getting them also to look more at taking more positions in medium-term and longer-term government instruments. And so that would mean that we can also get to a state where the market does more actively price the government debt. So we have auctions for government treasury bills and longer-term bonds, but we want to get to the point where we see a lot more dynamism in terms of how the bidding and the pricing is taking place on those instruments. And that part of that comes about by drawing in a lot more of those investors. So there isn't any turning a blind eye, so to speak, at that investor base. Strategically, we want to pull in that investor base more.
So, I also wanted to ask about the credit bureau, how their expansion of reporting agencies is going. I know they were trying to pull in other agencies to report.
I would say it's been very positive, but to some extent, we still feel as if we are in startup mode with the credit bureau, so there's still a lot of onboarding still going on, and we're trying to manage to make certain that we get all of these interested entities onboarded. That's very important, and I think we want to be able to also focus eventually more on how the credit information system is tracking the profile of commercial credit. But it's progressing, and for what is already there, it's already being made use of by lending institutions. So that's a good thing.
You see it starting to help the institutions as well as borrowers?
Trust me, it does help borrowers because, for once, a borrower can tell, in a consolidated fashion what information exists on their credit history, and in the process, clean up any inaccuracies in the record. So I think that's very important. In the past, there was such a thing as a credit reference letter that you could get when you were getting a loan from one institution versus another, but it really didn't say much compared to what is factually contained in the credit bureau database. So it is beneficial for borrowers, and it's really intended to be able to empower borrowers, particularly now that they can provide more factual evidence of their credit worthiness, and they can use that in many cases to get and negotiate better interest rate from lenders. All right. I think that concludes, and I think we will see you again probably at the end of October. So thank you all very much.